So for the first panel after lunch, I'd like to introduce the stellar panelists. We have Mary Catherine Lader from Uniswap, Geoffrey Klaus from Blockdaemon, Staci Warden from Algorand, Akbar Thobhani from sFOX, Leon Marshall from Genesis Trading, and the fabulous Kristin Smith from the Blockchain Association. Please welcome the first panel of the afternoon.
Well, good afternoon, everybody. I hope you enjoyed your lunch, and thank you for joining us today on what could be a conversation that would take all afternoon, but we're going to cram it into 37 minutes. TradFi and DeFi Converge, building better financial services. We have an all-star panel. Thank you, Rachel, for the wonderful introduction. Why don't real quickly, before we get into our conversation, we'll start with Mary Catherine. Give us a quick 30-second overview about what your organization does and what your role is, just to sort of level set for our audience here.
Sure. Thanks, Kristin. So I'm Mary Catherine Lader. I'm the Chief Operating Officer of Uniswap Labs, which is a team based here in New York City that's building on top of the decentralized automated market-making protocol and technology called the Uniswap protocol. So we'll talk a lot about the differences between DeFi, CeFi, and how they are both useful for TradFi players who are exploring and growing their activities in crypto. But in short, Uniswap lets anybody make a market for any token. So you can think of it as like YouTube to Coinbase's Netflix, for example. We've done $1 trillion of volume, have 3 million users, 70,000 different token pairs, and the fees on the platform are all redistributed to the liquidity providers. So my role is helping figure out what products we can build to grow adoption of that, because it's really innovative, transformative technology for financial services overall, how we can bring it to TradFi, and overall grow adoption of these decentralized services at the core of DeFi.
Jeff?
Hello, everybody. Kristin, thank you. It's really a pleasure to be up here on this panel with this group of innovators, so thank you. Jeff Klaus, I'm the Chief Revenue Officer of Blockdaemon. Blockdaemon is an institutional-grade blockchain infrastructure company. Institutional grade, meaning that we work with institutions, we KYC, AML, all of our clients. Our clients then service other clients. The institutional infrastructure, the infrastructure being everything behind the scenes. We are powering a strong majority of this industry as a whole. We started off 5 years ago running nodes. For those of you in this room who may not know what a node is simply a computer that runs a piece of software that allows you to interact with the blockchain. That node can be used for querying transactions, executing transactions, generating rewards. 5 years ago, ran a couple nodes. What we realized is as you run one node, it's rather difficult. 10 nodes is easier. 10,000 gets even easier. Now we're running over 65,000 nodes for over 60 protocols, generating rewards on a strong majority of those. The node layer is just step one. Beyond that, getting folks into crypto or any type of blockchain utilizing a crypto on-ramp, allowing you to on-ramp from fiat to crypto, moving forward, securing your assets with underlying MPC technology for security. Essentially, if you're working in blockchain in some way, shape, or form, you are likely interacting with Blockdaemon. If you're looking to get into blockchain, we can help you on that infrastructure layer.
Great. Staci?
And Blockdaemon runs a couple of nodes for Algorand as well, yeah. I want to just first poll the audience. How many of you have had a book written about you? We are Algorand. Anthony Scaramucci wrote this book about us. In Your Bag is one of your party favors. We were founded by a Turing Award-winning professor of cryptography at MIT named Silvio Macaulay. And he invented a couple of things that cryptocurrency ecosystem uses: verifiable random functions, zero-knowledge proofs, that kind of thing. And so he watched the space develop for a few years and decided he could probably build a better blockchain. And that blockchain is called Algorand. And I'm the CEO of the Algorand Foundation. And at the foundation, we're responsible for the ecosystem, the governance, the tokenomics, everything that is about making the Algorand ecosystem robust for all kinds of different activities that applications like Uniswap could build on top of. There's a couple of things about our protocol layer, which is the blockchain layer. We are very fast. So we do 6,000 transactions per second. We are very carbon neutral. So we use the energy of like 7 houses, and we buy carbon offsets to make sure that we're always carbon negative. We have finality and no forking in 4.5 seconds. We're going to 3.9 seconds quite soon. And we have transaction fees that are sub-penny. So these are all of the things that our founder was able to learn from watching some of the earlier movers before building Algorand. So we've never been down for a second since we went live, and ready to talk to you about all the things you can do with blockchain.
Akbar?
Thank you. Hey everyone, I am Akbar. I'm a co-founder of sFOX. We started sFOX in 2014. I was actually introduced to blockchain at MIT, so I actually know the professor of algorithms. We started sFOX in 2014 as a first traditional kind of prime broker in the crypto space for a lot of the traditional financial institutions. TradFis need a essentially seamless way to manage on-ramps, off-ramps, access to the nodes, access to the different blockchains. And so today we offer trade execution, custody, and staking services to all the traditional financial institutions.
Has Anthony written a book about you?
No, no. But I do have an HBS case, though.
Leon?
Thanks. Well, no one's written a book about me just yet, which is probably a great thing. My name's Leon Marshall. I run the sales team at Genesis. So Genesis, we're an institutional prime broker based in London, New York, headquartered in New York, and also in Singapore. We offer execution services for spot trading. We have one of the largest lending desks in the space, one of the largest derivatives desks in the space, operating since 2013. Very excited to be on this panel today to talk a little bit more around how we might help institutions who are looking to get access into the crypto space, a way to do that in an efficient and compliant way.
Awesome, great. Thank you, everyone. So I know many of you are somewhat new to crypto, though probably have been watching it pretty closely. But just to level set for those who are new, Jeff, maybe we'll start with you. Can you talk a little bit about what we mean by TradFi and what we mean by DeFi, and then what the heck is CeFi?
I'll give it my best shot. I spent the strong majority of the last 20 years in traditional finance, mostly on the technology side. When I think about TradFi, traditional finance, the way we've all been operating for the last so many years, and you compare that to CeFi and DeFi, the first thought that comes to mind is, in the TradFi world, we have the equivalent of CeFi and DeFi as they exist. CeFi being your large wirehouses, your Charles Schwab's, TD Ameritrade, Fidelity, Pershing. You work within Schwab, you want to buy or sell stock, they're often crossing it within Schwab. You want to borrow money, you're doing that margin within there. Everything happens within house. If you look at the other side of the spectrum, you're a hedge fund, you're running your own trade desk, you have your own research arm, you're doing everything on your own, getting a bit more aggressive, you're looking to arbitrage a trade, you're working a bit more in a equivalent of a DeFi space. So when I think about the two, there are a lot of similarities in the old school versus the new school. Where we're moving today and what we're doing as we get into the DeFi and CeFi space, I think of another area of my past. Back in the late 90s, I was working to implement the very first fixed order routing system. For those of you who are my age, you may recall when we faxed or made phone calls of orders down to the floor. Well, there was a time when we thought we were going to now start to route these, and people said it couldn't be done. Well, it could be done. We were also at that same time trying to compress settlement times from T+3 and T+5 down to T+1 or even T+0. What's shocking is that we still haven't achieved that in TradFi, yet when you get into DeFi, and even what you're saying in Algo, how many trades per second?
6,000 trades per second.
6,000 trades per second. And when those are done, they're done. They're settled. There is no waiting period for that. So we're very quickly moving into a period where we can bring a lot of what we've been trying to do for years into reality. So to me, this is just a very exciting time in the progression on something that I've started at 20 years ago that we're now seeing come to fruition.
Staci, can you go a little bit deeper and build off what Jeff was saying? Like, what is it that TradFi does well that DeFi doesn't do so well, and what is it that DeFi does do well that TradFi has shortcomings?
Yeah, so there are, I think, some essential differences, and there's probably 3 or 4 or 5 of them. And the first thing, and if you kind of come away from this panel really almost knowing nothing else, this would be the most important thing to kind of internalize. The history, I would argue, of financial innovation for the last 10 years has been about making the messaging between bank balance sheets more efficient, more secure, better, faster. And a blockchain is writing to one balance sheet. It's like everybody is writing to one ledger. Algorand maintains, you can think of it as a ledger. And so there's no sense in which the algo is actually moving back and forth. It's really digital cash on a ledger. Now, a couple of things kind of fall out of that. One is the essential difference between DeFi and TradFi is that those intermediaries, as Jeff kind of alluded to, are gone, and they're replaced by a smart contract mechanism. And a smart contract mechanism just says, if this happens, then that will happen. If this state of the world comes into being, then this payment will execute, for example. And out of that falls a number of very interesting things. One of which is that so the main thing that traditional finance does better than crypto finance does is credit. So there's no sense in which, and they're kind of two sides of the same coin, though. So in traditional finance, you have a credit score, and you can get credit. You can borrow money in excess of the assets that you have. And that's an absolute advantage, right? And that leads to fractional reserve banking and et cetera, credit creation in the economy. That's how the economy functions. Crypto does not have that, but it brings its own advantages. And so those two things go together, a smart contract and the fact that you don't need to do a credit assessment. And so really the nexus of a DeFi is that you can borrow if you over-collateralize, so you can't get credit. You don't have to have a credit score, but you can still borrow if you over-collateralize, and that collateral can be taken by the lender by smart contract automatically. They don't have to call you and say, hey, please, will you da-da-da-da. So they're different, but they both have good and bad sides to them. And of course, there's many other things that also fall out of that. I'm sure you'll talk about kind of the automatic market making and things that come out off of the back of that. Maybe I'll stop there, though, for now, because I think those are kind of the essential difference. And another one, though, if I could say, is that the direct ownership and the direct idea of how the platform is going is much more immediate. So you can, in a DeFi ecosystem, stake coins of the platform. If the platform is doing well, your coins will accrue value, and so you kind of always know how you're doing. You get rewarded for participating in the good governance of the platform, in the financial activity of the platform, and so that kind of it's quite immediate. It's not through these intermediaries. You have a very much of a one-to-one relationship with the platform on which you're operating as well.
Mary Catherine, maybe you can pick up on what Staci was talking. I think, for people in TradFi, when they hear how an automated market maker works, it's actually kind of mind-blowing. And can you go a little bit deep into that? Because I feel like that's one of the kind of core sort of DeFi applications out there, and Uniswap is obviously the leader in that. So.
Sure. So Staci explained some of the benefits of a blockchain broadly for financial services, and what that has meant for decentralized financial applications is that very, very, very small teams can write open source code that can do the work of large institutions in traditional finance. And I think Uniswap's an example. So Uniswap was started in 2018 by a guy named Hayden Adams who had no finance experience and no coding experience. And Uniswap is actually the first thing he ever coded. He was 23. He read a blog post by Vitalik Buterin, one of the founders of Ethereum, suggesting that an automated market maker would be a good application for an Ethereum smart contract. And so having read this blog post, he then sought to build that smart contract. And he did it with a $100,000 grant, and Uniswap has since then scaled to now be 70% of all decentralized trading on Ethereum, and the other stats I mentioned before, 70,000 tokens. So how does it work? I think I mentioned that just to give you an example of how powerfully disruptive that is to then have these open source capabilities at the core of a DeFi system. How does that work? It means that anyone can contribute a token and another token that has a liquid price to a smart contract, and the supply and demand of those two tokens will create a pairwise pool and the liquidity for a trading in that pairwise pool that then based on a simple pricing algorithm, originally X times Y equals K, a constant product function market making algorithm, would then determine the price. So all that is to say, you crowdsource liquidity. And so anyone can become a market maker by then depositing their assets. Anyone in this room could deposit the Ether in their wallet into a pool on Uniswap and get a receipt effectively of the liquidity that you've provided into that pool, and then you're supporting trades. So there's 190,000 individual liquidity providers that have operated through this protocol. And because it's a smart contract, it's self-executing code, and it is effectively permanent. So if our team, Uniswap Labs, were to disappear, it would continue to operate. It really is public infrastructure now at this point. So what teams like ours are now trying to do is say, what can you then make that useful for? Who should be using that and why? And one, I think, good example is that this kind of incentive structure to attract liquidity providers has actually now created greater market depth in some of the major trading pairs, like USDC to Ether, for example, a wrap Bitcoin to Ether on Uniswap's protocol than at Coinbase or Binance. So that ability to incentivize liquidity from anywhere around the world has actually created better execution and greater market depth. But that's just one example of now, I think, an open source capability that has a lot of different potentials in other asset classes and for lots of other use cases.
Akbar, how do you see traditional institutions looking at crypto, and how do you see them expanding into this space?
So that's evolved very fast in the last 5 years, I would say. If you think about the last crypto winter, at that time, every TradFi was thinking, how long can the crypto survive? Today, every TradFi is thinking, in this crypto winter, how long can we survive if we don't adopt crypto? So for a lot of the TradFis, it's actually an important aspect of remaining competitive and giving access to their clients. There's so much that's happening in terms of innovation, from Algorand and many other DeFis along the way. You're talking about 70,000 tokens actually being traded. These are really large numbers that they can actually participate in and offer that to their clients. But the biggest hurdle for them is really how do they get access to it? How do they do it from a compliance perspective, a trade execution perspective? And so that's kind of when they start, the first thing they're doing is I want to trade. And they get into it by trading. The second is custody. Right now you've got these coins, I want to put them somewhere. And then lastly, it's how do you use these things by getting access to the blockchain, lending and borrowing and so on. And generally what we've seen is, they do come to us like prime brokers so that we can give them a complete suite experience. Again, it's really primarily to be competitive in the market and make sure that they don't become irrelevant.
Leon, have you seen demand for institutions grow for just investing in DeFi? And what are some of the either hesitations that traditional investors might have, or some of the kind of opportunities that they see?
I mean, certainly at Genesis, we've seen not only an increased amount of interest in the DeFi space, but also we've seen an increased number of counterparts look to us to provide access to decentralized services. But what we've noticed is that a lot of the funds that we speak to are concerned with one thing, and that's the regulatory side. And what that looks like changes from fund, changes from fund to fund. So is the entity that you're dealing with licensed, or does it need to be licensed? Is the asset that you're exchanging a security or not a security? And are you comfortable with the counterparty that you're facing, and can you even tell who is on the other side? Those are the questions that we get from institutional participants, asset owners, hedge funds, even family offices. And then what we've noticed is that the market is effectively bifurcated between those who are much more comfortable taking that kind of risk, smaller hedge funds, family offices, versus those who are large institutions that are frankly not comfortable taking that risk because of other business lines that they have or other KYC, AML concerns. So what this means going forward is those participants are concerned pre-trade, not only with compliance, but security. Who's got the keys, and are we happy with those guys having our keys, and what's the insurance if things go wrong? To Akbar's point, actual trade execution, but what does best execution even look like on DeFi? And then post-execution, how do you do the reporting and monitoring after the trade? This is where we spend most of our time focused and looking to help those participants, and that's how we see some of those institutions get involved.
Jeff, can you talk a little bit about the infrastructure that's in place today, and what exactly is it that TradFi needs to access DeFi, or what is it that needs to be built in order to facilitate that?
Yeah, it's actually perfect. It plays really well off of what Leon was just saying. When you get into the infrastructure layer, what's most important is the compliance of that. So from an infrastructure provider perspective, we are very focused on what's happening globally. We operate on every continent outside of Antarctica, and what is the regulation in any given jurisdiction? From a institutional grade perspective, like I mentioned, KYC, AML, and everybody we work with, but more importantly, when we sell them, we are selling them tools to ensure that they can remain compliant. And as any infrastructure provider across the space, you want to ensure that they are ISO compliant. You're working with people who have audited financials. You're working with people who provide insurance against any of the events that can occur, whether it be slashing or any other downtime type of risk. So when we talk about infrastructure, so much of this is really about risk mitigation and planning ahead. You know, it's funny, I often say, and I maybe shouldn't hear, but I often correlate it to, no one really thinks about the plumbing that they install in their building until the toilet backs up. And when that happens, you very quickly say, ooh, I should have thought about doing that the right way. Well, those foundational layers are critically important as you lay the infrastructure for this industry. So yes, the ISO compliance, the audited financials, the risk mitigation across the board to make sure that you are working with players that can keep your business running and appease your clients' needs.
Thank you so much, Jeff, for that imagery.
Mary Catherine,
Remember it.
you touched on this a little bit earlier in that Uniswap Labs can go away and the Uniswap protocol will still exist and run and operate and thrive. Can you talk a little bit about the difference between the centralized core teams that build the protocols and the protocols themselves? And then is there a role for these centralized teams in working with TradFi?
Sure. So several of the DeFi protocols are just open source core technology that then need lots of other layers, whether that's infrastructure, compliance, and other products, a UI layer. You can think of automated market making protocol like Uniswap as like SMTP, like a core protocol for email. You still need a spam filter. You still need UI for your inbox. You still need all this stuff on top to make your email safe, easy for you to access, and really usable. And so Uniswap Labs is a core team of about 90 people now based in New York who are building some of those applications. So things like a widget to let you easily integrate the code in your website, a website on top of the Uniswap protocol that does filter and block and does not deliver all of the tokens our website that are necessarily available at the core protocol layer. And so it's through teams like ours that we're trying to answer some of the questions that Liam raised. What are the risk compliance regulatory questions that all kinds of different actors would need to answer to understand how they can access some of this core technology? Interestingly, in the past couple months, we've seen more interest and more serious sustained interest from TradFi partners, whether they are sort of intermediaries, funds of different kinds, really trying to understand, now that we've gone through a shakeup in the market, which of these technologies are here to stay, which teams have really thought about security, have thought about risk from a technology perspective as well as the financial perspective, and what applications might be useful. So absolutely, we just hired several people with TradFi backgrounds. I myself came from Goldman Sachs and BlackRock, and I think part of what we'll see in the next 12 months is the beginnings of applications of some of these DeFi protocols in the more scaled and more traditionally regulated context.
Staci, so we're starting to see some convergence here, right, between the two worlds. In your mind, what does the perfect market structure look like?
What does the perfect market structure look like? In 8 minutes? No,
Actually, like 2, because I got a few more questions.
Yeah, okay. I think, it comes down to probably latency would be one thing. So if you think about the NYSE or the NASDAQ, they do so much faster trade execution than, say, Algorand does, right? It's like hundreds of thousands of transactions in millionths of a second. But, they close on the weekend. They're like open till 4, and then you got to wait until Monday to do it again. So some around-the-clock element of traditional finance, I think, is something that they can learn and adapt from crypto, which is 24/7. We think it's cute, you know, when TradFi like waits for the opening bell kind of thing. The hard thing there, though, is, you know, nobody can move because when everybody else is stuck behind, because it's so integrated as a system. So how TradFi is going to get to a more instantaneous settlement is going to be interesting to see how it gets there, because you've got to kind of all move together. And then I will say the fee structure is also a little bit maybe skewed, and I think that there's so many intermediaries in traditional finance, and just if you stick to the trading example, that are just taking a little bit on the top, and then a little bit on the top, and then a little bit on the top. There's so many middle men there that DeFi can give you a much more immediate and a much lower cost experience. I mean, on Algorand, we're talking about 0.001 algo, right? I mean, this is like nothing to trade. And I think, though, that and I'll make this my concluding comment, I promise, that there are, you know, everything is both good and bad. And so the convergence has got to be where you take the best of some and jettison the worst of the other. So for example, you know, in Algorand, it's final in 4.5 seconds. There's nobody to call if you made the trade by mistake. Like, nobody is answering your phone. And so the idea that you've got all of this kind of intraday risk or a couple of day risk with banking, the reverse of that, though, is that charges can be undone when they need to be undone. And so it just, they will coexist. But I will say, and I think all of us, by virtue of the fact that we're on this panel, will say that the road from TradFi to DeFi is kind of a one-way street. You know, it's a little hard to go back once you're here. But I think we have to work well together and play well together, and we will naturally kind of coalesce around the activities I think that we're best at, the two of us.
I want to go back to Leon for a second, because he brought something up earlier around getting questions around regulation. I think particularly with Know Your Customer requirements, Bank Secrecy Act type questions, or sanctions compliance, like, what are you hearing from TradFi, and how are they getting comfortable specifically around, you know, those areas dealing with illicit finance to engage with DeFi?
Yeah, it's definitely the hot topic at the moment. I guess folks are familiar with what's happened with Tornado Cash, and there have been assets that have been delisted from some decentralized protocols because they were deemed to be securities, and some of the decentralized protocols are effectively self-regulating to some extent. What we've seen is hedge funds have sought access to DeFi and circumvented this problem by effectively investing in some funds, and also investing in corporate debt or some of the more public intermediaries such as ourselves. So they get access in less than ideal ways. What I expect to see in the future is what we're seeing at the moment, which is increased regulatory clarity, especially in the US. When we have increased regulatory clarity, I think we're going to find some of these funds get incrementally more comfort. The chief compliance officers will sit with PMs, and that they'll come to an understanding as to where they sit on that risk tolerance curve. In addition, we're beginning to see funds set up entities abroad, and you know, we certainly work with a number of US-based funds who have entities around the world interacting in the digital asset space. So I think that increased regulatory clarity will be the element which connects CeFi and DeFi, but that is going to be a long road, and it's going to require some compromise, dare I say, from the crypto community, because there are some central tenets and pillars of what decentralized finance means. For example, access and sort of the immutability of contracts. That may be challenged if we're adopting this in a regulatory framework that we're used to. And so I think that's a long road, and I don't think there's an easy answer to it.
We only have a couple minutes left, so Akbar, would legislation help with this? I mean, this is something I care about very much because we work on this at the Blockchain Association, but is getting a solid legislative framework, is that the answer here to provide this sort of certainty and clarity for the TradFi world?
It's important, it's a necessary but not sufficient condition. If tomorrow the laws were passed and clarity was there, I don't think every TradFi is running in. I mean, we have an entity in Singapore. We have clarity from the MAS in Singapore. We work very closely with them. We do have a BVI entity, so we've kind of built this global network. We do have a Wyoming trust license, and Wyoming actually has legislation on how to access DeFi staking and many other blockchain aspects, and it's actually in the, it is codified. So I do think that it's important to get that clarity. But in addition, for a lot of the TradFi, it goes beyond just legislation. It is about the operational aspects of KYC ML. It's about transaction monitoring. It is about having access to liquidity and speed. So I do think it's bigger, but it will help, right? And we will definitely take clarity on legislation because it does remove one of the bottlenecks in the market.